Welcome back to the Retire Young radio show. I am your host, Joshua David, having a great time in studio talking about the financial markets, how they work, and different ways us as the average investor can participate with the financial institutions. Al, as we continue this discussion about how the markets work with the institutional order flow, right? The institutions are creating these moves in the market, and quite frankly, they move the market. They own the market. Now, a lot of our listeners want to understand how are they doing that? You know, how are they moving the market, but also how are the institutions or the quote unquote, the smart money creating income in these financial markets? They use multiple markets. We have the stock market. There's also leveraged asset classes out there, the futures market, the Forex market, and the options market. So they're not just trading stocks. So let's first talk more about the stock market. We'll get into these other assets. What are they doing a little bit differently that is actually available to the public to create income?
Well, almost everything they do is available to the public. And one of the problems, I guess, that most people have is they don't know what those things are that the institutions are doing because they're really told that you should just invest in stocks or mutual funds, put together a long-term portfolio, hold on to it.
Blah, 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 buy and hold, right?
Well, yeah, and that's what most people are in. They're in a buy and hold investment strategy.
I think a lot of people are kind of sick of that strategy, too. I've been hearing a lot of people talk about that.
Well, that's because they haven't been keeping up with the market. They're seeing these great numbers that the market has been providing or producing, and they're saying, look, why isn't my portfolio doing the same thing? Well, that buy and hold really, for most people, becomes buy and forget. And what they're missing out on is being proactive in addressing different market conditions, basically just hoping for the best over a long period of time.
Is that a good strategy,
Hoping, guessing, praying, those are not good investment strategies. Basically, people are looking at kind of a one-size-fits-all strategy. And that's really not how the big players, the smart money, addresses the markets. And there's a difference in the way that you approach the markets for short-term, for income, for more immediate cash needs, as there is for that long-term wealth, because both are important.
So if there's a difference between the short term from the long term, talk more about the difference in the short term. What does that really consist of?
Right. If you're looking at additional cash now for whatever reason, or if you're an institution and you're looking at boosting your bottom line, you're looking at something that is not a long-term just buy and just forget about it for decades. That's really more what the buy and hold is. The shorter-term necessities, that requires a short-term vehicle, something that you get into and out of on a shorter-term basis. Maybe somebody is looking for a return on a daily basis or weekly or monthly basis, the potential for that. And that requires something that you don't hold on to for 10 or 20, 30 years to achieve. There are assets, there are strategies that are used for short-term investing and trading, specifically for that. That's the futures market. That's the foreign exchange market. That's the options market. Those are great short-term trading vehicles, although Forex and options can be used for more long-term investing also. But for short-term, those are the assets that the institutions are trading. They are doing that pretty much on a daily basis. But the ironic thing is that that's not what they're doing with their clients. They're putting their clients into that long-term portfolio, basically where for most people, the management of it is passed off to somebody else. It's passed off to, say, a mutual fund manager.
Yeah. Well, they do that because they have to. I mean, think about this. If you have capital with somebody, a money manager, whoever that may be, do you think they can manage, 100, 200, 300, 400,000, clients at one time? You can't, because think about this. Everybody has different needs. Everybody has different goals, but also everybody is a different state of their life as well. So you need a strategy that's for you, not the general public.
That's exactly right. And it may be different for different people. That's why any kind of an education plan, investment plan should be customized to each individual. People have different needs, different goals, different risk tolerance levels. So anything that you do really should be customized to you. Getting back to your point about the number of people that the Wall Street firms, the financial advisors work with, yeah, if you have 100, 200, 300 clients, you cannot possibly have enough time to devote to each portfolio on a short-term trading basis. So if you have somebody who's trading futures, for example, Well, they may be in and out of a trade on a daily basis, maybe in a couple of hours. Sometimes those are very short-term trading opportunities. It's not possible to manage individual portfolios that are maybe 100, 200, 300 clients.
Mm-hmm.
So it's much easier for them to pass somebody off to a structured kind of an investment like a mutual fund, or maybe a firm has maybe 4 or 5 different portfolios that they look at, but there may be hundreds or thousands of people in each of those portfolios. So they're not consistently managing for risk, and they're not managing for opportunities. That's something that each individual can do. I mean, you have the opportunity to control or look at each individual part of your portfolio, make sure it's managed properly for risk, make sure it's managed properly for potential returns.
Yeah, and just to explain that a little more detail, when Al's explaining short term, that doesn't mean, taking as many trades as you can. They say day trading. Everybody thinks that's a bad word. Well, all that really means is you're in and out of your position in the same day. And how the smart money is trading, they have their entry points where they're going to get in. They have their targets where they're going to get out, but they also have a risk management, a stop loss. So they know where and how to get in the market before they even get into the market. And that's how, you want to trade as an investor. Have your entry points, your targets, everything set up prior to price even getting to that area where we were talking about earlier of interest, where the institution, that footprint, is creating those moves in the market. So Al, we mentioned these other markets, these other assets. When we talk about assets, that would be the futures market, the Forex market, and the options market. So let's explain what those really are, because a lot of people are stuck just on stocks. They feel that's all they can trade and invest with. Well, the only reason they feel that way is because they don't know about these other assets.
Right.
So let's start with the futures market. What is that, and why would somebody might want to participate in that?
Yeah, first of all, I think when people think about futures and Forex or options, the number one word that comes to mind is risk, that they're too risky. I think Wall Street.
The only reason is because they don't know.
Well, that's exactly right. Wall Street has done a good job, I think, of conditioning people to feel that way. And I've said this before. I guess I think that the risk is not in the asset. The risk is in the trader. It's in the inability of the trader to understand or to learn, what each of these assets is comprised of, and then because each of them have little specific things that are unique to them.
Yeah, and that's why education is so important.
Exactly. Once you have the education and you understand that word that I mentioned before, risk, that is something that can be controlled, and that's the number one thing that we teach our students.
So explain the futures market.
Yeah, the futures market is basically just what it says. You're looking at what something is going to be worth in the future. It could be the major stock market. So anybody who says, no, I just want to trade stock, you have that opportunity within the futures world. You can trade the major stock markets, the Dow, the NASDAQ, the S&P 500, the Russell, foreign markets. So you have the opportunity to continue trading stocks, but with less money up front. So all of these assets we just mentioned have leverage, which simply means using a smaller amount of capital to control a larger investment. It basically lowers the financial barrier to entry. It is helpful for smaller accounts and also for smaller windows of time. The futures market, again, includes the stock markets. It includes commodities, currencies, interest rates, oil, gold, silver, your favorite.
Lean hogs.
Lean hogs. So someday I'm going to have a conversation with you and find out why you are so stuck on lean hogs.
What? On the next giveaway I do, when people call in, they have to mention lean hogs. That'd be kind of fun.
That's great. Let's do that.
Well, see you later.
Okay.
We'll continue that with the leverage.
Yeah, and the great thing about leverage, let's talk about leverage for a minute. That is, again, maximizing the value of every dollar that you have in investment. It's sort of like putting a down payment on a home, say a $20,000 down payment on a home that is worth $200,000, $300,000. That's leverage. That with a mortgage, well, you can do the same thing in these markets. With the futures market, could be anywhere from maybe 20 to 1 to 50 to 1, 100 to 1, depending on the different component of the futures market you're looking at.
So basically, for every dollar, you can control $20.
Yeah, exactly.
Okay.
Right. And that's really maximizing the value of every dollar that you have. That's what the institutions do. That's why so many of these big players, the smart players, are using these leveraged assets.
And these are available to the public.
Available to the public in futures trades almost 24 hours a day. The foreign exchange market does trade 24 hours a day. That's where you're looking at the difference in exchange rates between two different currencies.
Let's talk about that 24-hour day for a second. So you're saying, so if people are working during the day, they can still participate in the evening because it is actually open.
Exactly. And think about it for a minute. Just because our market closes, it doesn't mean that all of the other markets in the world close. There's still activity going on. And there's still activity in those foreign markets that will impact our market when it opens the next day. So having the availability of participating at different times, not only does it make it easier for somebody who maybe is working the 6.5 hours that the stock market is open, but it gives them an opportunity to choose when they want to do that. And and with the great thing about investing now, Josh, is that with the high-speed internet and the trading platforms, people can go anywhere that there's an internet access, and they can trade. You can trade right off of your phone. You can trade the futures market, the foreign exchange market, the stock market. A lot of opportunities for us as individual traders that we didn't used to have maybe 10 or 20 years ago.
Yeah.
Forex, again, as I mentioned, open 24 hours a day, 50-to-1 leverage. So every dollar can control as much as $50 worth of that investment. Options are something that you trade on an underlying, like a stock. Could be an options contract on an exchange-traded fund, which is like a basket of stocks similar to a mutual fund. You can trade options on futures on the futures market, on the foreign exchange market. Great leverage, both as far as the amount that you can control with a smaller amount of money, but also from a return standpoint, there's kind of leverage there. If you look at
set that too. There's actually strategies that are designed to set that return.
There are a number of different strategies you can use within the options market where you can define absolute risk and you can define the profit. Options can be used in up markets, down markets, and sideways markets. So you have the availability of participating all three directions. Futures and forex can also be used in up and down markets. So you have that opportunity. There are strategies there that can be utilized in an up market, a down market, and with options in a sideways market or just a trending market where it's moving up and down, where it really doesn't make any difference which direction it goes with certain option strategies. That doesn't make any difference.
Yeah, and that's a great thing. I mean, think about this. These 24-hour markets, I mean, especially the Forex market, some of the best investing is actually overnight because you have other parts of the country that are open, some big parts of the country. So there's a lot of movement or there's a lot of action in the market. So that's a great thing is people can participate any time of day because they actually are open. In this next segment, we haven't explained fully what the Forex market is. Mm-hmm. We know it's 24 hours, but we're going to explain more on what the Forex market is, more on a longer term horizon. We talked about short term trading and investing. Let's talk more about long term trading and investing that's not buy and hold. We'll be right back.